Yeah, let's go.
All right, let's do it. All right, everyone. So we're going to go through reading financial statements in 10 minutes, what to look out for. So this is a guide on how to read your financial statements. So here's what we want to cover. We want to cover a few topics. One is, before we dive into the financial statements, just a couple grounding principles to keep in mind as you look at your financial statements. Then we'll go through the 3 financial statements. The income statement, everybody knows that and everybody loves it. And then we'll go over the balance sheet and the statement of cash flows, 2 other financial statements just as important as the income statement, but maybe not looked at quite as closely. So hopefully you'll gain an appreciation for those 2 in your business. So that's what we're going to cover. So going and starting out with the grounding principles, really there's 2. So one, keep in mind that the financial statements are designed to, you want to match your income and expense with the business activity in the month. So you want your financial statements to reflect what happened, what was the results that were driven by your business. And that takes me to principle number 2, where sometimes cash, well, not sometimes, cash may not always equal revenue, and cash may not always equal expense. So what do I mean by that? So you may get some cash in for a job, like in the month of April, for a job you did in March. Well, March, you would have recognized the revenue because you completed that job, but you didn't get paid until April. So April you got the cash, but you wouldn't have any revenue associated with that. So just keep in mind that cash, when cash comes in or goes out, doesn't necessarily mean it's revenue or expense. Now, there could be the case where, you do a job, it takes you 1 day, you get paid $2,500, they pay you at the end of the day. So you would receive the cash and recognize the revenue all in the same day, same month. So a couple things just to keep in mind. And now I think we dive in with everybody's favorite. Corey loves the income statement. How could you
my
not?
personal favorite.
How could you not?
That's right.
So there's three key numbers you need to look at. There'll be lots of numbers on your income statement. It depends. There's numerous ways you can summarize it, or as much detail as you want to see. But there's really 3 key numbers. So revenue, that's how much your business is generating in sales. Gross profit, that's your revenue minus your cost of goods sold, or the cost for you to deliver that revenue. And then your operating income, which is going to be, that's what you have left over after you pay your overhead and your fixed cost. So these are the key numbers to keep in mind as we discuss the income statement. Now, a couple warning signs when you're looking at the income statement. So these are kind of calls to action. If you see a change in your revenue trend, maybe it's going down when it had been kind of consistent, or going up, that's going to be a red flag. You need to look into that, understand why. Gross profit margin going down. That could be a pricing issue. It could be a cost issue, but that's a red flag to look into what is driving that. And then fixed costs. You need to monitor your fixed costs in your business. Or do you have too much software? I don't think anyone has too much software, but I think, what do you think about that, Corey?
I beg to differ. This
Yeah,
is one area where I'm particularly focused on.
I think they call that
too easy to
expense creep.
Yeah, I've definitely seen that more times than one.
There you go. So just those are some things that could be some red flags that you would need to look into. So those warning signs. Now we'll talk about kind of the review process and maybe 5 steps to go through each month when you're reviewing your financials. So again, revenue growth. Are you up? Is it down? What's the trend? What's driving your revenue growth? Profit margins. Again, this is what the cost for you to deliver your service to generate your revenue. If that is that going up? Is that going down? That's going to, again, indicate you may need to look at your pricing. You may need to look at different suppliers because your costs are going up? Are you seeing fuel surcharges now on material deliveries that maybe you didn't see a few months back? So profit margins are always key to review. Then you want to look at your comparison of your current actuals, let's just say for the month, and compare that to where you thought they would be. What was your target? And then how does that compare to what you did in the prior year? Because that's going to give you some insight into what's going on in your business. And that's not just revenue, and that's not just profit margin. That's every line item on the P&L. You need to look at the variance, see if it's significant, and if it is, understand what's going on and determine if you need to take some action. Then, like we just talked about, the key variance drivers. So as you're looking at these versus target and prior year comparisons, what are kind of the bigger items that are sticking out? What can you, or are there items that maybe it's low hanging fruit, like we talked about? Maybe you got some software you're not using anymore. That's easy. You just get on the site and you cancel it, and then that cost goes away. Problem solved. This number 5, this is one of my favorites. It's looking at each line item in your P&L as a percent of your revenue and looking how that changes over time. Will give you a lot of good information. And then trends. I love to look at P&L trends, every line item, looking at the current month, how that compares to what happened last month, the month before, 3 months back, even going as far as back as 12 months, just to see what each line item is doing. How is it changing? What are we doing in the business that is influencing that? So that's the income statement review process. A lot of great information you can get out of your business to take action and drive some better results. So next we'll move on to the balance sheet, which I think is a very key schedule. This is where you're showing what your assets are, what you own, what your liabilities are, what you owe, and equity. Basically what's left over. It's the difference between your assets and your liabilities. So those are kind of the key areas, and what to look out for. So if your accounts receivable, your AR, if that's growing, that means you're selling things, but you're not collecting. So that would be an indicator that you need to look at your receivables or your collections process, because that should be a process that you have in place that your team is managing or you're managing. It's a process based to make sure that as you're reaching milestones in your jobs or you're completing jobs, you're getting payment quickly. If you got inventory, so you got a bunch of mulch that you've bought and you're doing across multiple jobs, like looking, are you buying too much or are you buying at the wrong time? So inventory, and hopefully you are tracking that in your inventory, because when you buy something that you're going to have around and use for multiple jobs, that is what that is. Third is if your balance sheet doesn't reconcile. So the good thing about accounting and your books is they all tie together and they should all reconcile. The income that you have on your income statement rolls into your balance sheet, a line item on your balance sheet. It all works together. The cash flow statement, which we'll go over next, you can track the change in cash on your balance sheet to your cash flow statement. So they all work together and they all tie together and they should all reconcile. And then obviously your debt, you want to keep track of anything that you owe, whether it's on like equipment, you got a line of credit for, seasonality, then you just want to make sure that you're tracking that appropriately as well. So those are some warning signs on the balance sheet. So again, kind of some steps to run through every month just to review this. So your bank reconciliation. So all your bank accounts should be reconciled every month. The number that you see on that balance sheet should match your bank statement. Sometimes it may not. If you still cut, paper checks, there could be outstanding checks, but your bank reconciliation will show how much outstanding checks you have so that you can match back to that bank statement. You want to look at your accounts payable and make sure that everything that's sitting in accounts payable, it's actually a valid bill that you need to pay. And if it's not, well, then that means, again, going back to all these statements tied together, if you have things that are sitting in accounts payable that perhaps you don't need to pay, or maybe you already paid, that means you have too much expense on your income statement, which that'd be a good thing because then you have more income. And Corey loves income. So always keep that in mind.
It's my favorite.
There you go. Then the equity roll forward, just looking at, like I said, the beginning equity, the net income from your income statement will show there. It's a part of the equation to get to ending equity. Accounts receivable is very similar to accounts payable. You want to make sure that you're looking at all of your open invoices, especially anything over 60 days. If you're going to go get a line of credit based on your receivables, if you do large jobs that go from from a couple weeks to a couple months, you're going to have receivables, and a lender is not going to basically give you credit for anything over 60 days usually. So you want to make sure that you're getting everything collected well under that 60-day mark. Debt schedule.
And sorry, you
Yeah.
said lender. How did you spell that?
Lender.
I just thought I might get to
Yeah.
it before the comments do.
Oh,
Is
good.
that Linder?
It is Li. Yes. So thank you for that correction. And
That's what I'm here for.
I've been working on this, but I'm a work in progress.
It's a process. I get it.
There we go. Thank you. Debt schedule, that's kind of straightforward. Just making sure that kind of similar to your bank reconciliation, that the debt that you're showing on that you get a statement from your lender and it matches up to what you're showing on your balance sheet. And then obviously just in accounting, the equation must balance. Asset equals liabilities plus equity. So,
oh, sorry, I was a little delayed here, but I thought I'd give you applause if that shows up.
There you go.
Maybe it doesn't.
Wonderful. All right, so that's reviewing the balance sheet. Moving on to the statement of cash flows. So the key numbers here on this statement are you're going to have you basically what you're doing is you're comparing, let's say month over month, there's a change in cash. Your cash went from last month that you ended the month with, $25,000 in cash. This month you ended with $150,000 in cash. What drove that change? That's the whole purpose of this statement. And it breaks it down into three types of activities. Operating activities. This is just the general business and what you do. Investing activities. So this is any cash spent to invest in equipment. Maybe you made an acquisition, that would fall into there as well. And then financing activities. Did you make a distribution to yourself? Because that would run through there. Any sort of debt that you received, that would be a positive, cash inflow, which would show up in financing activities. And then any debt payment that you would make would be a cash outflow and show up in financing activities. So those are kind of the three key areas. Here again, with the warning signs, negative operating cash flow. That means your business is not generating cash flow on a regular basis. So that would be definitely something to look at. Maybe you're profitable on paper, negative cash flow from operations. There could be just some timing things going on. Your receivables you're not collecting. So again, it's just kind of a red flag that something's going on that you need to get to the bottom of. And then financing cash flow is positive. I mean, that could be, because of, taking too much out of the line of credit or taking taking it too many months in a row. So just want to make sure that just you're tracking that just as close as you are that operating income on the income statement. Now the review process, just kind of walk through those three kind of key buckets in order. So operating, it really starts with your net income. So what did your business generate? And then kind of adds back non-cash items, talks about some of the changes in the balance sheet to give you kind of like, hey, the business just generated this much by, selling things and delivering, installing jobs. Investing, this is, like we said, what did you buy or sell? Is it showing up here? Because one thing you need to look at is if you bought a piece of equipment or you bought a truck and it's not showing up in your investing section of your cash flows, well, maybe it accidentally got expensed. And so you overstated your expenses, understated your income. So you'd want to make sure that you make that correction and that is accounted for appropriately. And again, financing, any sort of borrowing, equipment, lines of credit would show up here. Any contribution or distribution you do as an owner in the business, that's going to show up here. So you can track that. And again, once you take all these three into consideration, then you're going to see exactly where your cash flow went and how you went from, a bank balance last month of 50,000 to 150,000 this month. So those are the statement of cash flow review process. I think this just kind of sums it up here. This, what we call the 10-minute monthly review, covers all three of the income statements. Now, if you would like help with that 10-minute monthly review, we are more than happy to do that. And all you have to do is just go to our website. It's ascendfts.com. It's got these big like blue buttons or links, whatever you want to call them. You really can't miss it. It's in the top right corner and kind of in the middle. They say book a free consultation. Just click that link. We'd be happy to do the 10-minute monthly review with you. Anything else before we close out, Corey? You want to?
No, I think you hit it all.
Did I enunciate any other words incorrectly?
I don't believe so, but if I missed it, I'm sure someone else on the internet will they got my back. So
I welcome it.
No doubt.
I welcome all
Awesome.
feedback, concerns, complaints, and references to where I misspoke about words. So awesome. All right, that's your 10-minute monthly review.
Excellent. All right. Well, Thanks a lot.
All right.
All right. We'll
that's it.
Talk soon.